Hello everyone. Welcome back to FX Limit, your go-to place for everything Forex and trading. Today we have a very interesting and crucial topic to discuss, the impact of inflation on Forex trading. Inflation is a term that you've probably heard thrown around in the news or read in articles, but do you really know how it impacts your trading? Well, that's exactly what we're here to discuss today. First off, let's start with understanding what inflation really is. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, eroding purchasing power. Central banks attempt to limit inflation and avoid deflation in order to keep the economy running smoothly. Now, let's dive into how this affects the Forex market. When a country experiences high inflation, the value of its currency typically depreciates. This is because the purchasing power of that currency is eroding. Conversely, when a country has low inflation, its currency tends to appreciate because the purchasing power is not eroding as quickly. But it's not just as simple as high inflation equals bad and low inflation equals good. Central banks play a significant role in this dynamic. They use monetary policy tools to manage inflation and control the money supply. When a central bank raises interest rates, it can attract foreign capital, which increases demand for that country's currency and can lead to appreciation. On the other hand, when a central bank lowers interest rates, it can deter foreign investment, leading to a depreciation of the currency. Now, this is where it gets interesting for us Forex traders. Currency pairs are significantly influenced by these inflation trends and central bank actions. Traders closely watch inflation reports and central bank announcements to predict currency movements. When inflation is high and a central bank raises interest rates to combat it, traders might buy that currency in anticipation of appreciation. On the flip side, if a central bank is not proactive in managing inflation, traders might sell the currency, expecting depreciation. But it's crucial to understand that the Forex market is highly speculative, and there are many factors at play. Inflation is just one piece of the puzzle. Traders also need to consider other economic indicators, geopolitical events, and market sentiment. One interesting aspect of inflation in Forex trading is the concept of real interest rates. Real interest rates take into account the inflation rate. So, even if a country has high interest rates, if it also has high inflation, the real interest rate might be lower than in a country with lower nominal interest rates but very low inflation. This is why traders often look at real interest rates rather than just nominal interest rates when making trading decisions. Another important point is that sometimes the impact of inflation is already priced into the market. Traders anticipate central bank actions and adjust their positions accordingly. So, when an inflation report is released, if it's in line with expectations, there might not be a significant market movement. However, if the report deviates from expectations, it can cause significant volatility. It's also worth noting that different currency pairs might react differently to inflation data. For example, emerging market currencies might be more volatile in response to inflation data compared to major currency pairs. In conclusion, understanding inflation and its impact on Forex trading is crucial for any trader. It influences central bank policies, currency values, and subsequently, your trading decisions. As a Forex trader, you need to keep a close eye on inflation reports, central bank announcements, and adjust your strategy accordingly. Remember, trading involves risks, and understanding macroeconomic indicators like inflation is just one part of developing a successful trading strategy. Always do your own research, stay informed, and happy trading everyone. Until next time, this is FX Limit, signing off.